These are the most speculative stocks in the stock market today. So in today's video, we'll be looking through a few things. We'll be looking through the most speculative stocks that I own which I find attractive, as well as some questions in the comment section below. So let's talk about the most speculative stocks first. And I actually came across this comment in my comment section. So it says, can you make a video like this but in reverse? High risk, shorter term investments, 20 to 30% a year is not good enough for me. So let's talk about the first stock, and the first stock is Oscar Health. So Oscar Health in the past 5 days alone is actually up around 60%. So if you put your money into it for the past 5 days, you would have made 60% on your money already. So that is 6 years of returns in just 5 days alone. So if you have to put your money into Circle, it's even better. So Circle over the past 1 month is actually up around 173%. That is almost 3x on your original sum already. So if you took all your money and put it into Circle in the past 1 month alone, you would have made 3 times your money already. So for Circle, it is currently now worth 10% of MasterCard. So Circle's market cap is at around $55 billion, whereas MasterCard's market cap is at around $500 billion. But if you have to compare the net income of these two companies alone, Circle in the past 12 months has made around $19 million, whereas MasterCard has made around $13 billion. So you have one company in MasterCard that makes around 1000x of what Circle does, and it is only worth 10x in terms of the market cap itself. So there's clearly some form of discrepancy over there in terms of the valuation itself. So this is typically what you see in bull markets when speculative stocks get out of hand. So if you have to look back at 2021 as well, so this is ARK Investment. So ARK in 2021 was hyping up all your different high growth stocks. So they were buying a lot of Zoom, a lot of Tesla. And then Cathie Wood was talking about how Tesla will go to $10,000 a share pre-split, and how Zoom was going to be the biggest technology company ever. And then since then, the stock price from its peak itself is actually down around 56%. And in the past 5 years, this ETF has generated basically no returns. It is generating negative alpha, and Cathie Wood is actually one of the biggest value destroyers when it comes to your ETF asset managers. So this is the consequence of chasing high growth speculative stocks, and this is what you typically see in extremely exuberant bull markets. So how do you get returns from a stock? There are 3 primary ways for you to get returns. Number 1 is the earnings growth of the company. Number 2 is the buybacks as well as the dividends of the company. And lastly is the multiple valuation. So over the long run, stocks, they tend to follow the earnings growth of the company as well as the fundamentals of the company. The valuation of the stock could go up massively during a very short period of time, but in the long run, they usually mean revert. So you should only be buying stocks based on the earnings growth, not the actual multiple valuation and how much the stock has gone up, because a stock going up 50% or 60% in the past few days shouldn't be a reason for you to buy into the stock itself. So what should you do in face of this? So I know a lot of traders and a lot of investors, they are probably enticed by this. They want to buy into the stock because the stock has moved up by quite a fair bit over the past few days. But what you should be doing instead is to ignore the speculation. I know it looks enticing, but one must consider the downside when it comes to buying into this stock as well. Because Wall Street is a zero-sum game. For someone to make money, someone has to lose money. And on social media, you only see the ones that make money. Because the ones that lose, they won't post their losses online. So social media has a lot of survivorship bias, and when it comes to all your different stocks like this as well, from Oscar to Circle, for someone to win and for someone to buy at higher prices, someone has to sell it at a higher price. And for someone to make a 60% return on the stock, someone has to lose out by 60% as well. I know the allure of all these different hype stocks and all these speculative stocks is very enticing. But if you're a long-term investor, you should focus on the earnings growth of the company as well as the fundamentals, not so much the actual price action of the stock. Next portion, I'll be talking about some stocks that I still find attractive. It's in my portfolio today. So the first stock is Google. So Google year to date is still down around 10%. It is currently trading at a 19 times earnings. So Google currently is the largest company in terms of net income in the trailing 12 months. So in the past 12 months, Google has actually generated around $111 billion of net income, whereas Apple has generated around $97 billion and Microsoft has generated around $97 billion. So you have the largest company in the world in terms of net income trading at such a low valuation. Clearly there's something that Wall Street is worried about. So Wall Street is likely worried about the regulations as well as the competition to Google search. So in terms of Google search is your LLMs, and for the regulations itself, there will be a hearing in August where the DOJ claim will come to a settlement. So if you're buying into this stock, be wary of that date. But I think at current valuation, at current prices, Google is still presenting a decent opportunity. Next stock that I'll be talking about is ASML. So ASML today is down around 3% because of this news over here. So the US are preparing for some form of export controls on chips as well as all your different US tech to China itself. So that is why you're seeing all your different chip companies falling today. And ASML is a company that is experiencing this as well. But for ASML, it is currently trading at a 28 times earnings. And I think for a monopolistic company like ASML that holds almost 100% market share in your lithography space, I think it is a company that deserves a much higher valuation. So if you're to look at it from a historical standpoint, this company's median PE is at around a 33 times. So it is currently trading at a 28 times, signaling some form of undervaluation relative to its history. So for ASML, it is a quality business that I own. And I think at today's price, it is around fair value. So it's still attractive at today's price. Next company is Amazon. So Amazon year to date is down around 4%. It is currently trading at a 34 times earnings. So similar to the previous two companies, it is simply a valuation play. So this stock is currently trading at a price to operating cash flow of around 15 times. So the mean or the average itself is at around 19 times. So when you're buying Amazon, you're not only buying the Amazon stock itself or the Amazon website, you're buying basically a portfolio of different companies from AWS to retail to Whole Foods, and all your different other companies that Amazon owns under its umbrella as well. So for Amazon, it's a high quality business, and although it could be hit badly if there's some form of macroeconomic conditions, I see this company as a high quality one that will be around for the next 10 years, next 20 years or so. Next company is United Health. So United Health year to date is down around 40%, and it is extremely rare for you to see a Dow company that is down this much in such a short period of time. So I see this as a buying opportunity for United Health, although there are a lot of risk associated with this company. So if you're buying into the company, you should be aware of this risk. So you have regulation risk, insurance risk, and basically the healthcare industry in general should be an industry for you to avoid. But for United Health, I think it is a company, a high quality compounder based on its fundamentals itself. It's trading at an extremely cheap price, and the CEO buying into the share as well is a vote of confidence by the management itself. Last portion, I'll be talking about some questions in the comments below. So the first one, it says, I'd love to know your take on this. Do you see this as just another cyclical recession or something deeper? Do you think US-based companies might start relocating to more stable or cost-effective countries to survive? Also, with the recent Middle East tensions possibly pushing oil prices up, and considering how past spikes in oil have triggered or worsened US downturns and started depression, what are your thoughts on the broader implications, especially given America's current debt levels? Let me refer to what Warren Buffett said and his philosophy when it comes to investing. So these are some of the rules that Warren Buffett has given for himself. So the first one, it says, never follow the day-to-day fluctuations of the stock market. And then the second one, which is the important one that I'll be talking about, is don't try and analyze or worry about the general economy. So with regards to that, this is what he said. So if it's impossible to predict what the stock market will do from day to day, how can it be even remotely achievable to forecast what the economy as a whole will do in the next few years? The problem is some investors begin with an economic assumption about the direction of the economy and select only stocks which fit their model. In this way, the predictions become both self-fulfilling and self-limiting. A superior approach is to buy a business which has realistic opportunity to progress, regardless of whether the overall economy is expanding or contracting. A business which has the ability to profit in any economic condition is very valuable. So as Warren Buffett says, it is impossible for you to predict the economy, and addressing the debt level concern that the commenter actually raised earlier. So my personal belief is that the US economy is broken as soon as the government introduced QE to bail out all your different companies. But that was the only way they were going to save the economy from going into basically people going back to farming again. So my personal belief is that while the economic conditions in the US, they are broken, it is in one's best interest to basically take advantage of this economic conditions. So yes, although the debt levels in the US are unsustainable, I'm sure every individual will feel much better about making money than to worry about the debt levels every single day. So that's my personal belief. In the long run, the stock market will go up, and almost every single year you'll have a worry. So in 2022, we had the recession fears. In 2020, we had the COVID fears. In 2018, we had the tariff fears as well. So almost every single year, there's something to worry about. In the long run, in the next 20 years, the stock market will likely be a lot higher than it is today. So it's best for you to just invest your money into the stock market rather than sit out because you're worried about some form of economic condition. Next comment, it says, LVMH is currently a white moat company with a quality business worldwide in luxury sectors like leathers and wines. Its stock price has significantly declined over the past 2 years, mainly due to Chinese consumers buying less of their products. What are your thoughts on the company? So for LVMH, the stock is currently down around 30% year to date. It's currently trading at a 17 times earnings. So my view of LVMH is that it's a high quality business that is having depressed earnings as well as depressed sentiment. So normally when it comes to buying a stock, these two things combined together is the best way when it comes to timing your buy entries. So for LVMH, I view it as an extremely strong company under Bernard Arnault's leadership. And with its capital allocation skills, I think this company, if you buy it at the right price, it will likely generate alpha above the market. And so for me, I'm actually quite interested in this company. I'm reading up on it, but it definitely looks attractive at today's price. I hope you guys have found this one useful and invest safe.